Thank you, Sophie, for the introduction, and also thank you so much for the opportunity to present today. It's a big honor and very excited. Today, so as Sophie said, I'm a senior data scientist at RavenPack, specialized in global macro investment strategies and macroeconomics. I joined the firm in July last year. Before that, I spent 3 years at Goldman Sachs, also as a macro researcher, working in the investment strategy group in global portfolio solutions, and I'm a PhD economist by education. So today I will be presenting some of the most recent research that we have been doing here at RavenPack. So I sit in the data strategy team, and one of the mandates that we have is to help and inspire our clients in terms of how to use big alternative data, and of course the data that we have here at RavenPack, which is news analytics. Because there is often a lot of excitement about big alternative data, but unfortunately, it's very complex to introduce it, especially into existing investment processes. And so that's what we are trying to do in our team, because we are experts on the data. So we test a lot of different strategies, and we try to come up with new innovative ways of using the data and inspire our clients in this way. And today I want to present some recent research we have done, where we have taken one of the most used investment approaches, style investing, and two major asset classes: developed markets, fixed income, and FX. And we are going to show how we can introduce new sentiment into the framework seamlessly in order to boost the performance. So for those who don't know RavenPack is one of the leading providers of news analytics for financial services nowadays. We process news from over 24,000 different news sources in real time, and we have archives going back to 2000. The way it works is that whenever a news article hits our platform, we have a bunch of different NLP algorithms that process it. And these algorithms identify almost 7,000 different event categories and over 300,000 different entities, and produce a lot of different analytics, including sentiment, relevance, novelty scores, etc. And today we will see an actual way of trying to leverage all these structured big alternative data in order to plug it into an existing investment framework and try to improve performance. So in terms of the outline, we'll just make sure everyone is on the same page in terms of what style factors are. Just a general reminder, like the ones that we are considering in this research. We are trying to implement things in a very standard way. Of course, there are lots of different ways of implementing style factors, but we are trying to be like, the main objective is to show how sentiment can be added to this type of investment approach, and then you might have your own way of implementing these things, but it will be the same in terms of how you can leverage sentiment analytics. And then we'll go into fixed income, and in particular, I'm very excited to present some of the research that's just about to come out. Like, we are in the process of finalizing the paper on developed market sovereign bonds investing. And then we'll also go and talk about Forex, where we had a very similar approach, and it's a paper that we published in September last year. And in each case, we'll basically discuss the benchmarks, how we construct them, look at the benchmark performance, and then we'll go into the news sentiment overlay. So discuss how we add the news sentiment there, and then analyze what happens to performance once we do that. Okay, so let's start. Style investing. So the problem with traditional asset classes is because it can be challenging to get achieving attractive enough returns and also portfolio diversification. So, for instance, here you can see on the red, I've shown the problem in developed fixed income, for instance, is that government yields have been falling for the last several decades, basically, and so hovering around all-time lows, and many people are thinking that investing like a plain long exposure to fixed income is going to be challenging going forward. So thinking about alternative ways of trying to invest in these this asset class. But more broadly, style investing allows people to go beyond these traditional asset classes and get to something that captures alternative risk premium, which are typically backed by economic intuition. So style factors are systematic, disciplined investment strategies, which are gonna try to capture this alternative risk premium and aim at delivering long-term uncorrelated returns, uncorrelated both with the traditional asset classes, but also in between themselves. And originally, they have been mainly used in equities, going back to the early 20th century for some styles like value. But they have been over time progressively extended to all major asset classes, and most recently also to fixed income. And this is a very good reference for those who want to get more, which summarizes the way style factors can be implemented in all major asset classes: fixed income, FX, commodities, equities, sector, country level, and stock level. So in terms of the styles that we consider, we look at the 4 classic styles, which are value, carry, momentum, and defensive. So in value, which is probably one of the oldest styles going back to Benjamin Graham, the idea is to buy cheap and sell expensive. So the way it's implemented is that we're going to sort securities by some kind of fundamental anchor relative to the price, and then we'll see which ones are cheap relative to this fundamental value and which ones are expensive, and we're going to buy the cheap ones and sell the expensive and profit if prices revert to fundamental values, basically. The carry is the famous carry trade. So you kind of invest in higher yielding securities and you finance this investment by borrowing in lower yielding ones, and you're gonna profit if market conditions stay the same. Of course, they can be very big, and we'll see it in practice. They can be very big unwinds of the carry style when market conditions are not the same. But if market conditions are the same, you're gonna be able to profit from this style. Momentum, there are 2 different types of momentum. There's time series momentum and cross-sectional momentum. Here we're gonna focus because the idea is to use country level sentiment in order to boost performance of this style. So we focus on the cross-sectional type of momentum, and the idea is to sort securities by by the recent performance and buy the winners and sell the losers. So it is that recent trends are going to continue into the future. So you basically want to buy those that have been doing well recently and sell those that have been losing. And there are some behavioral models that explain why, for instance, momentum is a style that should command the risk premium about some underreaction in the short term and overreaction in the medium term. So there are a lot of economic and behavioral models that basically back up each of these styles in terms of explaining why fundamentally they should command a certain risk premium. And finally, defensive, which is not defined in all asset classes. For instance, in FX, defensive is not something that is defined, but for fixed income, we can definitely do that. So it's defensive quality. The idea is to sort securities by a measure of quality, and then you buy the low risk, the safe ones, and you sell the high risk, and you profit if the safer securities outperform the high risk ones. So these are kind of the 4 classic styles that we are going to consider. And let's just start with fixed income. In terms of the data, here we're going to use 18 developed markets. So a lot of the research that looks at developed markets fixed income focuses on either 6 countries, which are like the most liquid futures, or for those studies that look at the JP Morgan government bond index, they look at the 13 countries. In our case, we use the IC, both for government indices. So we can expand our sample, but we decided to expand it in a way that we preserve a sample where interest rate risk is the key driver. Because once you start mixing with credit risk, it becomes some of the factors have to be defined differently. So we kind of extend by adding, in addition to these 13 countries that are typically used, we also add countries like New Zealand, Finland, Norway, Switzerland, but basically covers 18 most developed markets. And we focus on 7-10 year maturities, but we also by the way, I'm going to also show the results for the 6 countries subsample, the most liquid futures, and also the 13 countries, just to check robustness, and also for those who may want to implement this in the future space. That might also be interesting to see whether that holds within that smaller sample. And 7-10 year maturities, we focus because again, to make it more relevant for those who want to implement in 10-year futures, government futures. But we also actually in the paper we test on all maturities and as a robustness check. And we are going to look at local currency excess returns again as a robustness check. We also looked at USD hedged returns, and we find very similar results. And so it's not something that matters that much. In terms of how we define the factors here for value, we need a certain measure of real yield, and typically it's defined as the nominal minus the maturity matched inflation expectations. But because we have a very big sample, it's for some of the countries who don't have the same availability of inflation expectations or not the same quality. So we decided to have a consistent definition across all countries, and therefore use the year-on-year CPI growth rate lagged 3 months, which is something that the academic literature also does whenever data availability is an issue. So the reason for lagging 3 months is to have a point in time data, and also allow for the first revisions with which will be the most significant ones. For the carry, we use the simple definition, the simple carry term spread. We just look at the 10-year bond yield minus the local short rate. So basically the idea is that if market conditions stay the same and you just invest in the bond, you get the carry return, because the next period the bond is going to move closer to its maturity, and so command a higher price, a lower yield. For momentum, instead of focusing on one specific trend, we decided to do a composite momentum by taking an equal weight of strategies based on 3, 6, and 12-month cumulative returns, just so that we are not too cherry-picking on one specific aggregation. We know in the literature very often people just focus on the 12-month return, which, I mean, again, we tested for robustness with simpler 12-month. It doesn't really change anything. For defensive, we look at sovereign safety, and we decided to use the rating. I mean, although it's a developed markets universe, there is still significant variability in the credit ratings, especially because we have countries like Italy and Spain, which got quite hit during the European sovereign debt crisis, for instance. And also Japan, with its exorbitant debt level, has a lower rating. So there is still significant variability, and we also, whenever the countries have the same ratings, we allow for ties and invest an equal amount. Okay, in terms of how we construct the benchmarks, very standard, like the first trading day of each month, we rebalance monthly. We rank the countries by the start score available as of the last trading day of the previous month, and then we standardize the ranks by subtracting the average rank and dividing by the standard deviation. And this is a more robust way of trying to implement style benchmarks, which tries to reduce the influence of outliers, but we also tested our strategies with the more commonly used long X%, short X% style construction, and the results still hold, but this is a more robust and allows for more portfolio diversification as well. And then we are going to scale each side of the strategy to a dollar long and a dollar short position, so that we have constant leverage, and we also duration adjust so that we have comparability across countries and over time, as well as duration neutrality of the long short portfolios. So here's the performance of the benchmarks. You can see, for instance, looking at the carry in green, it underperforms when market conditions are not the same. So around Great Recession, the European sovereign debt crisis, the China-related growth slowdown fears, and also, of course, the COVID. By contrast, for instance, the defensive one really outperforms around the European sort of debt prices and has a very strong negative correlation with carry, just because the lower yielding sovereigns are going to be the safest ones, and against but ranking low on the carry score. Then you have, for instance, value, which is more correlated with carry, just because it also uses the 10-year, and inflation rates typically in developed markets have been under control, especially during this period, and also tend to be highly correlated. So also underperforming around these episodes. And it's interesting, for instance, momentum is a little bit correlated, but with the defensive, because whenever a certain crisis episode in particular we see starts to unfold, it kind of like loads more on the winners as the crisis rolls out, and sells the losers. But then it's interesting how here, for instance, the aftermath of the European sovereign debt crisis, you see carry and value started turning around after Draghi's speech, and momentum started following them in autumn 2012, and whereas defensive kept underperforming, and this is why the factors are still very capture idiosyncratic risk premium, basically. And you can see it, for instance, here you look at Sharpe ratios. The combined strategy, which equal weights them, has significant portfolio diversification benefits. In particular, it like doubles the Sharpe ratio of any standalone, going to 0.77, and substantial reduction in maximum drawdowns from as high as 23% for the defensive to just 1.36%, and annualized volatility drops massively. So it's really captures the idea of factors being very diversifying when you combine them and capturing distinct risk premium. Now, in terms of adding sentiment to all this, RavenPack processes, as I said at the beginning, thousands of news articles. So you won't just like take all of this. Like, you need to first sub-select the relevant news, and then once you have done that, you create a kind of sentiment signal, and then you overlay it to the benchmark weight. So how do we subselect news? Because we have a sample of countries where interest rate risk is the primary driver. We are going to focus on economy-related events, which are like the ones that are going to define the economic outlook and the interest rate outlook for the respective countries. So we are going to select events belonging to the economy topic. And this includes some, these are events at the group level. So in RavenPack, we have several subgroup levels, and at the category level, we have almost 7,000 different events, and that would be events as granular as inflation up or inflation down or inflation unchanged or inflation guidance. So we are able to spot very precise events. But then as you group them, for instance, at the group level, the economy topic would contain events about balance of payments, business activity, consumption, credit, etc. And you see here, for instance, by country, after we've done the selection, we have a good mix of different events for each country, and there is like a good representation across all of the different countries as well. So we select events related to economy. We also select those entities that are places and organizations, so that we get rid of micro level news about firms, etc. Then relevance is something that captures when is it that the event and entity are being identified. So we set it quite high, like at least 90, which means a headline, so that we are able to remove the noise and really be very confident in the identification of the events. And then event similarity days is something that allows us to select the to deduplicate, because a given news article can appear on different websites and on different news sources. So it's going to be repeated in our data set, and of course we want to get rid of it because we want the most novel novel news only. And so this is how we can use these event similarity days in RavenPack to duplicate and basically keep just the first instance of a given event within a period of 30 days. And then we also remove events that are neutral, and the reason is because they are not going to carry a lot of very significant news. Like, just to give you an example, for instance, just a plain central bank meeting event is going to be neutral, or a rater event, or just something that doesn't have any direction, like inflation unchanged. So we get rid of these events so that we really focus more on the dynamism. So that's how we do the first step. Like, remember, we select the relevant news first. Then we go to now that we have our subset of news, we're going to use that to create our sentiment signal. And here we will use a sentiment signal in RavenPack, which is called the composite sentiment score. It's basically a document level score, which was trained using several natural language processing techniques, such as bag of words and Bayes classifiers, and it was trained on equity markets intraday data to determine how positive or negative the language of the story is. And all the training was done on random samples and performed before July 2007. So there's absolutely no look-ahead bias, and this is just a score that's trained, and we still use that same score. And so we are going to use this complete score. We compute a daily version of it, and then we of course need to smooth it out because of the daily frequency. It's quite noisy, and for as we'll see later on, for a very fast asset class like FX, for instance, it works, but for fixed income, it's a bit too noisy. Like, information tends to get into the fixed income prices at a slower pace. We need to smooth out the sentiment signal a bit. That's why we consider 4 different windows: 3, 5, 10, and 21 days, trading days. So it's weekly, bi-weekly, and monthly. And then we create a daily rolling volume weighted moving average, because on certain days we have more volume, on the days we have less. And we take the inverted CSS because, remember, it was trained on large cap on equity markets. So good news for equities is typically bad news for bonds. So that's why we need to invert it to create the appropriate signal and introduce the overlay to the fixed income market. Then we also normalize it using a rolling z-score with a 3-year look-back window. And in terms of, in RavenPack, we have the millisecond stamp, so we make sure we cut the time such that we do not introduce any look-ahead bias in terms of the news that we take into account when we create our daily news score. Especially typically you look at the country which has the first closing time, and we tried a few robustness checks here as well in terms of varying it. And we are going to focus on the multi-CSS because, of course, we have these different windows, but we checked and they are all robust. And so we decided, instead of starting to cherry pick, we just create a equal weight strategy, which is going to equally weight the strategies that use each of these different sentiment scores. And so basically, we can think of the multi-CSS as a bit of introducing some time decay, because, for instance, the most recent days are going to enter in all of these 4 windows, whereas the older news are only going to enter, say, in the 21 windows. So I'm going to present the multi-CSS, but the paper contains also the disaggregated results just to show the robustness. Okay, and so here is how we introduce the sentiment. So our sentiment score, inverted CSS with all this processing is this SIT, and this is the weight we had from the benchmark. So what we're going to do is we're going to use the exponential function and also a scalar, which allows us to control the tilt magnitude. In default, we set it to 1, and this basically shows you what happens. So the benchmark weight, we're always either over or underweight, depending on the actual benchmark we have. And then we introduce sentiment, and you see how it tilts it. It never changes whether we're over or underweight, but it's gonna change the amount by which we do it. And this is at the monthly frequency, just to illustrate the idea that you can increase or decrease the scalar, and then you also get you are able to tilt further away or from the benchmark. And then of course we renormalize the weights so that we still keep constant averages as before. And these are the results. So starting with these multi-CSS strategies for the fixed income factors, now with the sentiment overlay. So in each case, the white one is the benchmark. And then you have the whether we do the daily, weekly, or monthly rebalancing, because of course sentiment is available daily, so we can potentially rebalance daily, but then sometimes like you might want to rebalance weekly or even monthly. And here you see that for most of the factors, the daily and the weekly perform similarly, except for value, where daily is a better one. And for the combined strategy, actually the weekly is the one that performs the best. And you see that the monthly improves returns, but at the combined, for instance, these are the Sharpe ratios. It doesn't seem to improve Sharpe ratio, and the reason is because, remember, the combined is already a very well diversified benchmark, and so by adding sentiment, we reduce, because sentiment is the same score for all of the styles. We of course different countries, but we introduce some extra correlation. This is why when you look here at the actual table, you will see that in the combined strategy, we improve relative to benchmark at all frequencies. We managed to improve returns significantly. And at the daily and weekly, we managed to improve Sharpe ratios quite substantially, from 0.77 to 1.04, 1.07. But we also increase a bit the annualized loss. I mean, in actual absolute terms, they stay relatively small. But you increase because you introduce a bit of extra correlation to your stance. But it's interesting that on a standalone basis, the monthly also always, almost in all cases, improves the risk-adjusted performance, definitely improves the returns, and in some of the cases, significantly also reduces the max downs. For instance, for the defensive, the max down goals is reduced by significantly, and you also it's interesting how, for instance, for the defensive, you manage to turn around the performance from a negative to a positive, and results are quite robust. And in particular, it's interesting also that you manage to increase annualized returns quite significantly, because fixed income is a space where people often need to use leverage in order to achieve a level of annualized returns that they want. Whereas here you see that annualized returns improve at all frequencies, and at all frequencies, the Sharpe ratios of standalone factors improve substantially. Now, in terms of breaking down performance, so we see that how by being more dynamic in the style implementation, through having the style sentiment tilts, we're able to improve performance. Like now we're gonna look at how is that achieved. Well, what we do here is that we split our sample in between the countries that we overweight and underweight based on the multi-CSS signal, and then we long those that we overweight and we short those that we underweight, and we look at the excess cross-sectional returns on any given day. And what you see here is that both the overweight and the underweight generate performance. So we are basically going long countries when they do better than expected, and we underweight them when they do cross-section, they do worse than expected. So basically, we time at the right time. We did the right timing, basically, thanks to the sentiment. And in particular, it's interesting how, for instance, the underweight helped us a lot during the European sovereign debt crisis. So it meant that we were more underweight than the style benchmarks were telling us, and this helped us like hedge the portfolio better. Whereas the overweight has a pretty like stable outperformance. Also, are we lucky on just certain countries? Is that what's happening? No, it's not, because as you can see, this shows the over and underweight percentages by country, and so there is a good mix of being over and underweight of a country over within the sample. This is the relative performance. So here we just do a strategy where we, in addition to the sentiment, we show to the benchmark, and it's just to see whether there is constant outperformance, and you can see that it is, and that there is no like one period where you get all of your boost in performance and then you basically underperforming. No, there is like some significant outperformance throughout the sample, as you can see with this blue line. These are these alternative country universes that I talked about. So we consider the 6 countries, the 13 countries, and also the European sovereigns. And again, these are the Sharpe ratios. And for instance, for the 6 countries of the most liquid futures markets, you can see how now, even at the monthly rebalancing frequency, you are able to significantly boost your risk-adjusted returns, not only for all of the standalone style factors, but also for the combined strategy. And similarly for 13 countries, for all standalone, like the main results, like for all standalone, you're able to boost significantly risk-adjusted returns. And for the combined strategy, you are able to do it if you rebalance based on sentiment on a daily and weekly frequency, and similar for the Europeans. So it comes just to show you the robustness of the results on different sub-samples. And finally, the scalar, because you might be wondering what happens if I scale more or less, especially for those who are more concerned about transaction costs, you might want to scale less, so kind of have a more dynamic implementation thanks to the sentiment, but not as dynamic as with a scale of 1, because you want to save on transaction costs. And you can see how actually at the combined strategy, you can also have a smaller scalar of 0.5, and you're still able to significantly boost performance, both on the weekly, on the daily, weekly, and even the monthly, even with a 0.5 scalar. So that's kind of a very encouraging result as well, and also similar type of outperformance with the standalone factors as well. Okay, now let's go quickly in the remaining time, try to look at the Forex markets where we do something similar. So here we consider 7 developed market currencies, and we use continuous futures from Stevens Analytics. And for the different factors, we have a quite standard approach. Value, we look at the real exchange rate, which says like the purchasing power parity, so the nominal should be equal to the price levels ratios. So it's kind of like capturing the real exchange rate. Carry, it's the standard carriage rate. So you invest in high yielding currencies, you get the short-term interest rate of the local market. And for the momentum, we use something similar to what we had before, so an equal weight of the signals based on the 3, 6, and 12-month momentum scores. For benchmarks, actually here we were doing something more standard. So we were just going long, like sorting the countries based on the scores, the style scores, and then creating dollar neutral portfolios by going long the futures of the 3 currencies with the high scores and shorting the futures of the 3 currencies with the lowest scores. And these are quickly the performances of the benchmarks. You see like the carry, for instance, the big carry unwind here, because carry became a very leveraged and crowded trade prior to the Great Recession. So it had a very big drawdown here, and then you also see value and momentum not performing really well. And again, the combined strategy helps you by reaping portfolio diversification benefits, and annualized returns are positive. You manage to reduce the vol significantly, and the max redowns as well. So again, this idea of combining styles to get to something that is very well diversified. And now we add sentiment in a very similar way. So here we consider the 27 countries and regions that use these 7 currencies, and again, macro level news, similar selection. Here we also add this 1 day, just because the FX markets is faster and it reacts to the 1 day news as well. And the sentiment signal is going to be constructed and overlaid in a similar fashion as what we just saw. So I'm not going to go there and just go straight to the results. So again, as you can see, you managed to, we use the multi-CSS strategies once again, and you managed to improve performance of each standalone factor substantially. For instance, for the combined, you go from 0.29 information ratio to 0.73, and you managed to boost annualized returns substantially from 68 basis points to over 200. Again, annualized vol increase a bit, but actually the max redowns here decrease a little bit. And again, each standalone factor you manage to improve substantially. So like on the momentum, for instance, you're able to turn around from a negative IR to a positive IR. And when you consider the combined strategy, you again you short you hedge with the benchmark here. You see how like the performance is very. This is a combined strategy, like equal weight of all the different style factors. You are able to basically have a substantial outperformance over time. And again, we do the standard checks of whether the overweight or the underweight is giving us the performance. And here you see there is some negative correlation just because of the fact that currencies tend to move together. And this is why, if you remember, we are long the overweight and short the underweight. So they both help us, but there is some negative correlations in between them. And again, the country split, so that we are not just like one or two, but like by currency, we have a good mix in each of them. And this is just showing again the scaling of sentiment here. Actually, when you scale more, you are able to boost performance, like also like going to in this direction that FX is faster moving than fixed income, and more reaction to sentiment as well. And this just shows you what happens to the distribution of the weights. So remember, because here we have this long X percent, short X percent number of currencies more. You can see that you have a bimodal distribution, but then as you start introducing sentiment, you manage to kind of create more normalized distribution of the weights. Okay, so now the conclusion, because I also want to leave some time for questions. So in terms of conclusions, what we did here is that we saw how style factors, they allow you to get to something that is captures alternative risk premium, and by combining them and correlated different styles, you're able to get substantial portfolio diversification. With the new sentiment, what you can do is be able to implement the style factors in a more dynamic way. And especially if you are able to do it on a daily or weekly frequency, you are able to get significant improvements in the risk-adjusted performance. In particular, in fixed income, if you look at the 18 developed markets, you are able to increase your Sharpe from 0.77 to 1.04, and for the most liquid 6 bond markets, you are able to do it also substantially from 0.43 to 0.68. And also in FX with the 7 developed market currencies, there is a substantial boost. Now, going forward, what we plan to do is also to extend this approach to emerging markets. And there actually other types of sentiment, not just economy, because in RavenPack you have the economy topic, you also have topics related to politics, related to environment, sustainability, and governance. So you can create much more interesting also combinations. And in emerging markets, this is potentially is going to matter much more. And also we plan to try the same type of approach for commodities and country equity indices. So that's kind of in terms of conclusions. And finally, I started by saying that we do this research, that we are an internal team within RavenPack, a bit like an internal client, consuming the data and trying to produce our research in, but we have a lot of data on our research, like over 200 different research papers have been published on RavenPack data by both industry and also a lot of academic papers. So it's always very exciting to see new research and to do it ourselves as well. So with that, I'm going to leave hopefully 5 minutes for any questions, and thank you so much for joining the session today.